In this video, you'll learn about two covered call writing tools that I use and how you can use them to generate income. Hello and welcome back to the channel. If you're new here, my name is Rick Orford and I'm a Wall Street Journal best-selling author, and I've been trading stocks and options since 1999. I'm also regularly featured in publications like Yahoo Finance, NASDAQ, Business Insider, and more, so you can trust what you hear on this video. That said, I'm not a financial or investment advisor, so everything on this channel is for information only, and it's not deemed to be financial advice. Of course, I never pass up the opportunity to discuss stocks and options. So if you happen to learn something new or like the video, I invite you to subscribe, click that notification bell, and if you're really impressed, maybe think about sharing it with your friends. These very small things help get the word out, and your friends might thank you for it. Okay, so let's get started. Covered calls are a very popular option strategy, and I've published quite a lot about them. If you want to know more about selling calls in general, here's a video that's pretty popular and covers the topic really well. But in this video, we're going to be covering the tools for writing covered calls. And today, I want to do a deep dive into exactly that, the tools I use to write covered calls. And I want you to know that I'm not really into gambling, and that means that when it comes to selling options, I like to stack the odds in my favor. And I know a lot of you have asked about a video or for a video about the tools that I like to use, and you know that I like to use Option Samurai and Bar Chart. So without further ado, we'll start with one of my most favorite options writing tools, and that's Option Samurai. Option Samurai is an option screening tool that allows you to search hundreds of thousands of options combinations for the trades that meet your specifications. It's kind of like a search engine, but for options trades. The platform is very easy to use with a simple user interface and is very customizable. It has a very customizable filtering process that's also user-friendly, and I think it's perfect for new options traders as well as those who are more experienced. That said, if you've been trading options for a while, you'll also appreciate its in-depth screening tools that allow you to select from dozens of filters to tailor the results exactly to your preferences. Now, let me log into Option Samurai to show you exactly how it works. Right after the login page, we can see here the main page, and this is where you can compose a new scan. And here you can choose a variety of options trading strategies to fit practically every market condition and preference. For even quicker results, there are predefined scans right on the main page, which are arranged by the different available strategies or market conditions. And here, you can choose from a wide variety of strategies related to covered calls and, of course, market conditions to get a neutral, predefined covered call scan. Then, I just click on my preferred scan, and we have the results. It's that easy. These predefined scans can save you a ton of time if you're new to the platform. Now, let's move on to composing new scans by clicking on the Compose New Scan button. And for this strategy, we're going to select Covered Call. Now, since we're using Option Samurai, it's going to suggest buying both the underlying security and selling the call option at the same time, which is also known as a buy right. And later, I'll show you how to use another tool to write covered calls on stocks you already own. Alright, so in case you haven't heard of a buy right, well, the idea is to buy shares and sell a call, and either keep the shares and repeatedly write calls on them for as long as possible, or you can use a buy right with the intent of getting assigned to maximize your profit and close out your trade. Think of it as buying and selling a stock with just a few extra steps, but extra profits. So let's look for some covered call buy rights using Option Samurai. As you can see, the covered call strategy is the default, and we already have a bunch of results here. All we need to do is set the filters to specify our own unique preferences. For this covered call example, let's say I'm okay with getting assigned if there's a possibility for extra profits, but maybe I'm not totally opposed to keeping the shares for future covered call writing. So here, I'll set the probability of expiring worthless to say 60%, and that means I have about a 40% chance of being assigned. After changing any of the preference, don't forget to click on the Run Scan button to get the new results. As you can see, the top choice on the list is the Invesco QQQ, or the QQQ Trust Series 1. And this is an ETF that tracks the NASDAQ 100 index with a 68.45% probability of the option expiring worthless. And once you click on the result, you'll get a step-by-step on how to set up the trade and your expected results. Oh, and by the way, sometimes you might see a gray or yellow telephone icon beside the stocks. And the gray one means that the company has an earnings call in maybe 1 or 2 months. And the yellow ones, well, they indicate an earnings call in less than a month. Typically, earnings calls mean volatility for a stock, so you can keep that in mind. And it's pretty handy if you're looking to trade around earnings calls, or maybe not. Anyway, let's break down the trade. So this trade suggests buying 100 shares of the QQQ for $432.75 and sell a call with a $444 strike price for between $4.32 and $4.38 in premium. So let's say you get the midpoint, which is $4.35, and it expires in about a month from now. Given that data, we can define the potential profits and losses of the trade. So let's discuss the scenarios then, starting with what happens when your short call gets assigned. In this scenario, let's say the price of the QQQ goes above $444 and the covered call gets assigned at expiration. To figure out the profits, we first need to subtract the buying price from the strike price, and that works out to $1,125 for the shares. Then we add the premium received times 100 per options contract, so then we get $1,560 in total profit as long as the QQQ ends over its $444 strike price. Of course, if you bought QQQ for $432 and sold it for $444, well, you'd have made $1,125. But now, by selling the buy right, it boosted your profits when the markets went up. But what if they don't? So for covered calls, you're always guaranteed to keep the premium. This is income you get to keep no matter what happens. And with a covered call, losses happen when the stock moves below the strike price. And they're only paper losses until you sell the stock entirely. And what if the call option expires worthless? Since we've established that the trade could go either way, and maybe the stock will trade below the strike price at expiration, well, you'll get to keep the premium and your stock. But now what? Well, the good news is that you can now roll your trade and write more covered calls with your QQQ shares, potentially increasing your profits beyond how much you would have gotten if you had sold the shares outright for $444. And you can do this as long as your shares don't get assigned. But what if you're happy that your shares get assigned? Well, for that, you might choose to sell an in-the-money covered call using a buy right strategy. If you write a covered call that's far enough in the money, you're almost assured of being assigned. To find in the money or ITM covered calls on Option Samurai, you have a couple of options. First, you can change the probability of expiring worthless to less than 50. Second, you can use the moneyness filter and select below stock price. Once there, we can see that SPY tops the list, and let's click on it to see the trade. According to Option Samurai, we can buy 100 shares of SPY for the current price of $501.98, and then write an in-the-money call with a $496 strike price that expires in about 2 weeks. And as of this recording, you'd collect $11.09 in premium, or $1,109 per contract. To calculate your maximum profit, we'll subtract the premium you received from the difference between your SPY purchase price and the strike price, which works out to $511 per contract. As long as SPY stays above $496, you make $511, well, minus any trading fees and taxes at the end of the year if it's applicable. And since the call was in the money, there's a better chance of assignment, which is what you might want. If SPY goes below $496, then the option will expire out of the money and will likely be unassigned. Now, you might be wondering why you'd go this route when you could write out of the money covered calls without taking a cut off your premium. Well, that's because with ITM calls, or in-the-money calls, or any other contract for that matter, they tend to be more expensive because they have intrinsic value. Remember, the premium from the out-of-the-money triple Q was $4.35. And with the SPY example, despite taking a shall we say a loss on the stock, we still managed to come ahead at $5.11. Intrinsic value is another fascinating aspect of options trading, and I have a video up here that discusses it much more in depth. So yes, I think Option Samurai is one of the best option screening tools for an easy yet entirely customizable experience. And you can try it out, and I've left a link in the description, and you even get a free trial. But what if you don't care about writing covered calls with a screening tool? Maybe you just want to sell covered calls on stocks you already own. Well, for that, we can use Barchart. So we've already established how easy it is to look for buy rights using covered call screening tools like Option Samurai. But what if you wanted to write a covered call on stocks that you already own and want to give it the best possible chance of it expiring worthless so you can keep the stocks for the long term? And that's where Barchart comes in handy. Barchart is an online market and commodity data provider that has tools that investors can use to analyze and monitor their trades. The website offers several free features and tools like watch lists, screeners, and options market overviews. And we'll take a look at the last one right now by going to barchart.com and clicking options right here on the top. Here, you can see several sections, such as unusual options trading, most active options, options news, and strategy-specific ones, like the covered call table. It gives you a nice overview of the market, which is perfect for kind of like those broad stroke ideas. Now, to specifically use Barchart for writing covered calls on existing shares, you'll first need to go to the company profile. Let's say you have 100 shares of NVIDIA that you'd like to write covered calls on, but you don't want them to be assigned. Well, you want to keep your chances as low as possible. Well, for that, you're going to write an out-of-the-money call option. The question is, how much out of the money? To figure that out, I'll go to the search bar, type in either NVIDIA or NVDA, and select NVIDIA from the list that appears. And that will bring me to the company's profile page. To get the options data, look on the left-hand side of the screen and click on Option Prices. Now, once you're on this screen, you can choose the expiration date that you desire, and then you'll see a list of call options with data like strike price, premium, volume, and my personal favorite, delta. And why is it my favorite? Well, it gives me a rough idea of the call option's probability of expiring worthless. Delta answers the question, how do I figure out what strike price I should pick to avoid assignment, while still making it worthwhile to sell my covered calls? Delta is an options Greek that measures how much an options premium is expected to move in relation to the underlying security's price. Delta is expressed from -1 to 1 or -100 to 100, which is the same thing except for the extra zeros. Anyway, an option with a delta of 0.5 can also be referred to as a 50 delta. It means that all things being equal, premiums will move up 50 cents every time the underlying security moves up by $1. Pretty easy. However, there's another way to utilize delta to improve your covered call strategies, and that's by using it to figure out the probability of the call expiring in or out of the money. And let me explain using the 50 delta. If you're buying a call, a 0.5 delta option tells you that your option has a 50-50 chance of expiring in the money or out of the money. Delta is directly proportional to the probability of it expiring in the money. And when I say in the money, I mean that the security is trading as little as 1 cent more than the call option strike, right? Now, I admit this is a bit of a simplification, but just enough so you can use delta as a tool for options trading. Now, if you want me to do a deep dive on delta, leave me a comment down below. And while you're down there, don't forget to hit like and subscribe if you liked the video so far, right? Anyway, okay, let's get back to the topic. So, how does delta work when selling covered calls? Well, delta is inversely proportional to the probability of the option expiring out of the money. On the other hand, you could say that for the call option buyer, the delta represents the chances that the option will expire in the money or profitable for them. But who cares? You're the one selling covered calls, and if you don't want to get assigned, then you want to sell low delta call options. If you sell a high delta call, like a 70 delta call, well then there's only a 30% chance that it's going to expire worthless. But if you sold a 30 delta call, then there's about a 70% chance that it'll expire worthless. And to calculate the chances manually, take 1 minus the delta and you'll get the chances that that call option will expire worthless. And why do you want the call option to expire worthless? Well, because maybe you want to keep the premium and the shares. Now, let's get back to bar chart and see the delta in action. So here we're on NVIDIA, and we'll switch the expiration date to about a month from now, as you can see, June 21st. And here we can see that the delta for the last short call on the list is 0.46. And that makes the probability of the option expiring worthless only about 54%. I think that's a bit aggressive. Now, a safe delta level for a covered call is around 30 or less. So for that, we're going to need an expanded list of covered calls to see the strike prices below a 30 delta. To get that, I'll go to the drop-down menu and then click on the 50 strikes plus or minus, which shows me the 50 price levels above and below NVIDIA's current price. And there we have it. According to bar chart, short calls on this list with a $1,020 strike have a 29 delta, or a 71% chance of expiring out of the money. Premium bids are $30.65 per share. And that means that you can sell a covered call to someone that's already lined up to buy it for $3,065 per contract. Also, you might have noticed that the most traded strikes are round numbers. like the 50s or 100s levels. I guess we're just kind of funny humans that way, wanting to have the volumes at these round numbers. So there you have it. These are most of the techniques and tools that I use when writing covered calls. What are your thoughts? Do you have any questions? Do you write covered calls? Let me know in the comments below so that we can keep the engagement going. In the meantime, I wanted to thank you so much for watching the video, and I hope to see you again. Bye.